If you watch a stock's price throughout a single trading day, it looks like pure chaos. The price jumps up, falls back, and stutters hundreds of times before the market finally closes. This line traces every single move the price made during the day. It shows where the stock ended up, but it doesn't show you the struggle that happened along the way. To make sense of all that noise, professional traders use a different tool, the Japanese candlestick. Think of a candlestick as a visual scorecard. It's designed to capture the result of a financial tug-of-war. On one side of the rope are the bulls. These are the buyers who are aggressively pulling the price upward. On the other side are the bears. These are the sellers who want to drag the price back down. The final color and shape of a candlestick tells you exactly which side won the battle over a specific period of time. Every battle has a beginning. This starting line is called the open, the price of the stock when the clock begins. If the bulls take control early, they might pull the price up to a peak. This is the high. But the bears might fight back, dragging the price down to a bottom point. This is the low. When the time for this round ends, the price stops at a final resting place. We call this the close. The space between where the price started and where it finished becomes the candle's body. If the bulls won and the price ended higher than it started, the body turns green. If the bears won and the price dropped, it turns red. Those thin lines extending from the body are called wicks. They show you exactly how far the losing side managed to pull the price before they were ultimately overpowered. Every completed candle is a physical record of the pressure that side felt during that window of time. Here, the bears have been in total control, dragging the price lower with every new candle. But then we see a candle with a tiny body and a very long bottom wick. Traders call this the hammer. That long wick shows that the bears tried to crash the price even further, but a massive wave of bulls suddenly rushed in, pushing the price all the way back up to the top. This shape tells us the bears lost their grip on the rope, and the bulls are likely to pull the trend in the other direction. Now, consider a moment where the bears only have a slight advantage, creating a small, weak red candle. Suddenly, a giant green candle appears that completely swallows the previous one. This is a bullish engulfing pattern. This shows the small group of sellers was completely overwhelmed by a larger force of buyers. These shapes aren't random glitches. They are the evidence of shifting momentum, the moment when one side finally breaks and the other takes command. When you zoom out, you see that a stock chart is actually hundreds of these individual battles laid out side by side. The chart begins to reveal a story. You can see the specific moments where the sellers finally gave up or where the buyers staged their most successful comeback. Now, these patterns are not a magic crystal ball. They don't guarantee what the price will do next. Professional traders look at these patterns as pieces of a larger puzzle. They wait for this visual evidence to align with other data before they decide who is actually winning the day. Try it yourself. Search for a company you know, find the most recent candle, and see if you can tell who is currently winning the market's tug-of-war.